Bitcoin just nuked below 78,000 overnight, but here's the strange part. The ETF flows were actually flat, so if it wasn't institutions pulling out, what actually caused this flush? Today's story is price-driven, and we're breaking down how Bitcoin fell, the evidence around forced liquidations, why Binance is in the spotlight again, and how gold and silver just quietly echoes the stress. Let's start with a full Bitcoin environment check. On the daily chart, Bitcoin broke down violently through the 83 to 85,000 zone, a range that had held since December. The move bottomed around 77.8 thousand before stabilizing. Now, open interest got hammered, down about 6.28% in the last 24 hours. Binance open interest dropped negative 9.72%, while Gate.io and DYDX flushed nearly 15.5% and 17%. That's not people taking profit, that's forced liquidations. Funding stayed mostly positive, meaning long traders were still dominant before the move. And when funding is positive, longs were paying short to stay open, a signal of crowding risk. Then came the liquidation wave, 714 million on Bitcoin, 951 million on Ethereum, and 163 million on Solana. So we're looking at a total over 2.15 billion. Binance alone saw 26.9 million in liquidations, and the heat map shows how bit zone under 83,000 were swept clean with very little bounce. And here's what didn't happen. Now the total spot ETF flow was negative 509 million, but nearly all of it came from IBIT, BlackRock's ETF, while GBTC was flat. FBTC and ARKB even saw light inflows. So again, this wasn't institutional exit en masse, it was retail leverage breaking down. So from the market environment conclusion, what we can understand is that this is a thin market under key support. When positioning is crowded and liquidity is shallow, moves will get violent really fast. Now let's zoom into Binance because the role here might not be coincidental. Lately, a report from BitMEX Research connected a flash crash back in October to a single Binance market order that triggered a cross-platform wiped. Now the logic is pretty simple. Binance has the largest BTC perp liquidity, so if you trigger cascading liquidations there, the whole market follows. And here's what matters now. Binance still holds over 19% of Bitcoin perps open interest. Despite regulatory shakeups, they remain structurally central. So what happened this time? Trader built up bullish long positions, especially on Binance, where funding was positive and open interest stacked. Liquidation engines started to trigger. No major ETF move, no Fed speech, no CPI, just a positioning cascade that turned into waterfall. That's why this Binance story might not be just a blame passing. It might reveal the core fragility of Bitcoin right now. Not a lack of demand, but a system where the mechanics of demands are brittle. Before we continue the video, while I'm on a trip, Weeks is doing an elite exclusive event for everyone who's in a private Telegram channel. If you don't know how to join this, make sure you click on my bio. These are the details. Feel free to come in here, grab the bonus, test out the platform. I personally have been enjoying this for the past 2 years. If you have not heard about this, make sure you go into my playlist where I present how to use their product. If you're new to crypto or future tradings, make sure you go through those videos because I believe those are going to be very helpful for you guys. Now this event has officially been launched, so make sure you don't miss out on this and drop into the group and say hi. Now let's continue with the video. Now let's pivot into something quieter, but maybe more telling. Gold and silver. Over the past 48 hours, gold dropped from 5,602 to a low of 4,679, a brutal 923 drawdown before slightly rebounding. Silver didn't hold up either, falling from 121 to 73 at the lows, down nearly 40% intraday. That's not just noise, that's deleveraging. And here's why it connects to crypto. When macro desks take a hit on one asset, like gold, they often reduce exposure elsewhere to manage risk or meet margin. Bitcoin, being liquid and volatile, is often the first thing cut. Even more telling, there was no direct macro driver here. There's no Fed, no CPI, no geopolitical bomb. Gold just sold off into weak bids, and that's often a sign of profit taking, sign of stress, and probably not a rotation. Gold ETFs also saw light outflows despite being less linked to monetary policy, suggest risk-off flows across the board. So what looked like a crypto problem might have actually started in metals and spill outwards. It's a classic risk unwind, and there's no single villain, just too much leverage hitting too little liquidity. So the takeaway from today is that Bitcoin didn't crash because of ETF outflows, it crashed because retail long position were stacked. Also, potentially Binance liquidation engine remains the gravity well of crypto, and liquidity under support vanished like air. And while the ETF narrative stays calm, metals were flashing red. Gold dropped nearly $1,000, silver lost almost 40% in hours with no headline reason. That's just not volatility, that is a stressful market. And in this kind of environment, it's not about headlines anymore. It's about how exposed people are, where stops are clustered, and how shallow the order book is when things get moving. We're not making predictions, we're watching the mechanics. And this week, the mechanics were clear. The system is still extremely fragile, and it doesn't take much to break. Alright, that's what I have for you guys today. If you feel like I missed anything, feel free to drop a comment. And if you found this video helpful, make sure to drop a like and subscribe. I'll see you in the next one.